Hi, Brock VandenBerg, President of TaliMar Financial. I am getting a lot of calls from investors about rates and how the current conflict in the Ukraine and inflation is affecting them. Before I get too far in this discussion though, it'd be extremely helpful if you give this video a like and subscribe to my channel. We post a ton of great content about investing in trust deeds and content about where the industry is going. So let's go ahead and get started. Over the last 45 days, we've seen a considerable rise in rates on hard money loans. Now, many investors in trust deeds or mortgage funds, most likely the viewers of this video, haven't probably seen any increases in their returns. That's because those rate adjustments are happening at the institutional level. What do I mean about the institutional level? Let's back up a bit here and discuss the recent evolution of the trust deed space. Up until 2013, the hard money space had been primarily funded by private investors, trust deed investors like yourself. Around 2013, institutional investors started to enter the space, providing hard money lending companies capital to fund their loans, essentially replacing the reliance on the private investor. This happened for a number of reasons, but mainly because institutional investors were looking for higher yields in a low rate environment, and the hard money space provided that. Up through 2013, the hard money space was extremely fractionalized with very little structure. Hard money lenders would originate loans and then sell them to the private investors. But there really wasn't any structure or uniformity to the process. With technology, that changed, and the institutional capital provider was able to work with hard money lenders to create consistency and processes to their platform. This allowed hard money lenders to increase the pipeline of loans they could originate, knowing that they always had an institutional buyer for the loans that they originated. In 2016, we saw an avalanche of investor capital entering the space, and the idea of this national hard money lender with very cheap capital became very mainstream. Additionally, you started to see some consolidation in the space as institutional capital started buying national hard money lenders. These well-capitalized, institutionally backed hard money lenders created efficiencies in the underwriting and closing process, creating a very competitive landscape and putting extreme pressure on rates. During this time, institutional investors developed platforms for hard money brokers also to sell their loans. Now, brokers who weren't big enough to attract institutional capital partners or buyers could still participate now in these low rate loans by simply selling their loans off individually. These are loans that would have gone to private investors, but now they're going to an institutional buyer. So as long as those loans met the specific parameters of that institutional buyer, they had a much more efficient way of getting that loan sold. Additionally, brokers could capture 100% of the underwriting fees and sell that loan for a significant spread. For example, if the broker closed the loan at 9%, they could sell that loan to that institutional buyer at 6% and earn not only their upfront fees, but that significant spread between what the note rate was and what they were selling to the investor. Best of all, they weren't responsible for the back-end servicing of the loan. The space quickly changed from being dominated by the private investor market to the institutional investor market. Now you're asking, what does this have to do with rates? Well, institutional investors provided consistency to hard money brokers by offering standardized rates to them. No longer does the broker have to guess what the rate should be on a loan because they're no longer going to the private investor. They're simply taking that loan and selling it to the institutional investor using the rate sheet that institutional investor gave them. When I use the term rate sheet, they provide the pricing of what that loan should be or what they're willing to pay for that loan. This has worked well over the last couple of years because rates stayed relatively stable, actually decreasing at times as institutional buyers started to compete with one another to buy these loans from hard money brokers. Again, this is why rates have come down so much for the private investor, because the private investor is now competing with institutional capital to invest in these loans. Okay, Brock, how does this affect me though? Well, the institutional investors need to earn a certain yield. And when there's instability in the market, those rates fluctuate, which is what you have over the last 45 days. In fact, rates offered by institutional investors have jumped over a full percentage point. Okay, so institutional rates have jumped in the institutional world, but why not the trust deed or mortgage fund world? The main reason rates haven't changed for private investors is that because rates for institutional capital is significantly lower than what the private investor is willing to accept. I'm estimating that difference is probably between about 1% to 3%. Where a private investor may not go below 7%, an institutional investor would be willing to buy that loan at 6%. And they're able to do this is because they've created efficiencies on buying and selling large portfolios of loans. These institutional investors have created so many efficiencies. Most are buying notes within fractional percentage rates of one another. As a result, if one goes up slightly, another is going to go up slightly. Or if one goes down slightly, another institutional buyer may go down slightly. For the private investor, however, the industry remains relatively fractionalized. What one investor will accept versus another is still quite different. So as long as one private investor is willing to buy a loan at a lower rate than another investor, and the number of investors willing to buy at those lower rates are significantly, they have a lot of capital deployed, you're going to still see rates remain low. What does the future have to hold? I think in the short term, the private investor returns should remain relatively stable. The good news is that I don't think that they're going to drop anymore, and maybe there's a negligible increase. However, with the political instability in Ukraine, investors are moving out of the stock market and moving their money into more stable investments, such as trust deeds and mortgage funds. As a result, any significant increases in rates should be tempered by more of that private capital entering the market. When will rates finally increase? Investors will experience a significant increase in rates if instability in the global markets due to Ukraine or inflation get worse. This will force institutional buyers of loans to reduce the risk profile and therefore scale back the purchases of loans, putting pressure on the private investor to fill that void. This should result in higher yields. You saw this early in COVID. When COVID became a big issue, all the private money brokers that relied on institutional buyers could no longer fund their loans. The capital market for these loans disappeared. The institutional investors disappeared. And that literally happened overnight. Many didn't have the ability to shift to the private investor because they became too reliant on institutional capital. We here at TaliMar Financial didn't make that mistake. We've always relied on the private lender through our trust deed platform and our mortgage fund to fund our loans. So even though institutional investors were not buying, we were not really that affected. In fact, we were actually able to provide our investors a slightly higher return during that period of time. So as I mentioned, this period in the market saw a boost in investor returns, probably for a period of 6 to 9 months when the capital markets had exited. But they did return about 9 months after first COVID hit. And so that's why you've seen rates again drop some over the last, I'd say, 12 to 18 months. So depending upon what happens in Ukraine, rates should remain steady with the potential for an increase. If there are wild swings in global markets and institutional buyers exit again, rates will go up. Rates could also go up further if the private investor gets nervous and sidelines their capital, simply meaning that there's just less capital funding hard money loans. But that being said, we will be monitoring this closely and we'll be sure to provide you updates to where the market and industry is going. I want to end this by saying that TaliMar Financial and our team support the people of Ukraine. In fact, we have a team member who lives in Ukraine. We're constantly checking up on him and his family to make sure he is doing well. I'm confident to say that from our 2,000 investors to you, we wish you the very best and we support you in your country. I want to say thank you for listening. If you are interested to learn more about the trust deed platform or TaliMar Financial Income Fund, our mortgage fund, Please visit our website or contact our investment relations team. We remain very busy originating new loans and are always looking to raise new capital. Thanks again for listening, and don't forget to hit that like and subscribe button to our channel. Thank you.